let me introduce myself. David Stevenson. I head up AltFi. So we cover the industry from a news perspective, and I managed to sneak this event. We've got a big event in New York in a couple of weeks' time ourselves, so I managed to sneak it in just to talk a bit about innovation. And we've got a fine motley cast here of innovators. And what we're going to talk a bit about is what I think is the nitty-gritty of it. What does innovation actually mean, and what does it mean for you people looking into the industry? A lot of talk about innovation, but what does innovation actually mean? And I'm really going to talk about 3 or 4 things, really. We're going to talk a bit about product. What is product innovation? Because, and I'll put it to the guys in a second, in fact, this industry, I don't think, has really innovated very much in product. In fact, there's still largely the same set of loans and in the equity crowdfunding space, equity that we have had before. And then people have played around at the margins. But has there been innovation in terms of the actual products? Because you have to ask yourself, just how many more times can we basically sell loans to a different group of people? So that's one question we're going to ask. I'm also going to talk a little bit about process, because I think process is an area of innovation. Because looking at the surveys, and we talk about this in AltFi all the time, actually when you talk to customers, and I'm sure you guys will back me up on this, people care about process, how quickly they can get access to a financial product is a really important part of what they want to do. And then I want to talk a bit about pricing as innovation as well, because I think pricing is a very interesting area. Pricing both in terms of the borrowers, in terms of what they're willing to pay for the right kind of process and the right kind of products. But also pricing for the investor, because I think investors have different appetites for risk. And then I want to finish on what I think is the $64 million question, which is mobile. Because for an industry that is supposedly innovating, the industry is pretty damn pathetic when it comes to things like mobile. And I was trying to work out, actually, how many people had a really radical mobile platform. And I'm still trying to work it out. Maybe you guys can help me who they are, because I don't think there is anybody. So actually, in terms of technology, where's the innovation going to come from? So we've got a very interesting range of people's views on this. So let me kick off with that first question about product innovation. We've heard a lot of stuff today about loans, but effectively that's what we're talking about, really lending. Where's the innovation in products? What is there? I mean, are we talking about innovation in the end customer? Are we just saying we're going to lend to different people? Or are we actually going to lend in a different way to different people? Go on, kick it off. Go on, see. Come on, Christoph. You're smiling. You go for it first.
Well, I suppose I've got the mic, so I suppose.
Yeah, exactly.
Start. Well, within Folk to Folk, when you talk of innovation, our product is very simple.
Yeah.
Most definitely very simple. In fact, it's one product and a fixed term and a flexible term. So, but I guess from an innovation perspective, I would say that we not only have a platform. A tech platform, we also have a face-to-face model. So we're finding whether that's lenders and borrowers are still looking for the opportunity for a face-to-face proposition. I'm not talking about hundreds of branches through the UK.
Yeah, not reinventing the banking.
No, not at all. We've virtually got four offices through the southwest, which is where we were born out of.
And it's important to those people who don't understand. Folk to Folk is very regional focused.
Absolutely, and that's from an innovation perspective where we do it. So our lenders, it's very community-based lending. So we have lenders who have the opportunity to lend within their own community and choose the loans that they will want to go into within that community if they see fit. Some might not necessarily need to or want to. And we're finding that not only are they getting a good return on their money, they're actually seeing where their money is actually being used within their own community. When I say community, it could be the wider county or even closer. And from a borrower perspective, the same really. They're also, whilst we have borrowers who are keen to obviously just go directly online and have a quick answer, for the applications they're putting through. At the same time, we also offer the opportunity for them to come in and talk to us. So,
just to pick up on that, is that affecting the pricing of risk? So do you find that having, I don't want to sound like League of Gentlemen, local products for local folk, but is it actually mean you're getting a better return because you're de-risking the proposition because you're actually meeting people?
Yes, I would say so. I mean, we have one rate, which currently is at 6.5%, so we aren't risk-based, secured lending. So.
Okay. Christoph, let's go with you next. Again, what about this product innovation? Are you just fundamentally having to redesign the loan and just sell it to a different bunch of people?
I think we take a very customer-centric view on this. And, a loan is a cash product, so cash is most of the time the same. But we like to think much more in terms of our customers. And we provide credit to small businesses, and they are a very specific customer group. In the UK, they're about 5 million, and they do probably as many different things that you can do as a profession. And the small businesses, they're very, very good at the product level, but finance doesn't necessarily come that natural to them. They don't have an MBA, they don't have a CFO, they don't have a treasurer, and they're very good at what they do. So someone who's selling shoes would be very good at choosing these shoes and selling them. So going to a bank and actually thinking about the financing is not natural to them to think 3 years ahead in projections. And so on the product level, we have a live integration with Alibaba.com, which is, I think, one of the most exciting innovations that you have in small business lending in many, many, many years. You've seen in consumer lending checkout financing through PayPal and various others, Klarna, but you haven't seen anything like that in the small business space. And so every small business that is buying stock from China through the Alibaba.com platform can check out with a credit facility provided by us. And that's naturally embedded into their operations.
Christoph, what's the average duration on that? What are you looking at? Are you lending out at about 1 month, 6 months, 1 year, 2 years?
So we would be financing the underlying transaction. And small businesses that are trading on Alibaba usually wouldn't buy stock for £1 billion. These are usually ticket sizes that would go anywhere from a few £1,000s to maybe up to £100,000. But it is naturally embedded into their sales cycle. As if you buy something through that platform, you will receive it probably 2 months later, and then you will sell your good over the following 4 to 6 months. And so having the financing matching exactly the duration of the asset that they're buying is incredibly helpful to them. And I think it's certainly something that we're looking to replicate. I think in the 21st century, finance companies have to adapt themselves much more to the end customer. And technology is a very, very powerful tool for that.
And so with you, in a sense, there's two elements. There's partnership, working with Alibaba as your innovation, and there's process. Because I understand with your process, it's very quick. You maybe don't have to pop into a branch where you do with David, but you might have to actually, you get stuff really quick. How long would the average processing time take?
So certainly, this is an innovation on the product side. It will take us probably a few hours from an application to process that and make a decision whether we want to fund to that. And so, in process innovation, we have really innovated on the way how we are collecting information about our customers when they sign up. Yeah. Through electronic integrations with platforms like eBay or Amazon, payment processors, accountancy software, or banks to understand the customer electronically, at virtually no cost. And how
much? We'll talk a bit about technology when we talk about mobile, but everybody talks about big data and the ability to, it's a great term people bandy about. How much data do you actually manage to trawl on your customers online so you can make that assessment? Is it just the basic kind of 8-10 fields, or do you go beyond that?
We would really go way beyond that. So we are. If you take one example of a customer who might be trading on eBay or Amazon, we would see the entire trading history of that customer, the customer feedback. We would of course also look at more traditional data sources that banks would look at, so bank statements, cash flow statements, and the credit history of both the company and the guarantor of the small business, the main stakeholder. But all of this happens in real time as someone applies, and so we'll get a much more granular picture of our customer within really minutes of the application process. So I think a lot of the reasons why funding hasn't gone out to small businesses is the historically incredibly high cost of underwriting of these small businesses. If it costs you £2,000 in underwriting to underwrite a £20,000 loan, then it will take you a very, very long time to break even simply on the operational cost related to this. So that's an area we have spent a lot of time and money on getting this cost down.
So data helping to get pricing of risk appropriate. Martin, let's just move over to you at the end. What about innovation in terms of products for you? You're in a very different space again.
Yes, so we're back in the consumer space.
Absolutely.
So we're a platform, so we look at innovation on both sides. So one is for investors, one's for borrowers. And on the investor side, we're really focused on creating a good product for the growing landscape of sophisticated investors on platforms. So people who have higher return requirements and a good understanding of credit risk. And for these people, we create access to consumer loans that are high margin. That is by being open to a slightly wider risk spectrum, and also by writing smaller ticket loans. So banks and existing larger platforms write loans that are more than about 2.5 times the size of ours. And so
what would your average or median size loan be?
It's around 3,000.
Yeah, okay.
So we built technology to write these smaller loans with smaller margins than in subprime, but higher than in prime, with a high degree of automation and lower cost. And we make that.
I suppose you say by subprime, you mean just below prime.
Below.
Or do you actually mean the American subprime?
So we mean we are just outside of prime.
Below prime. Yeah.
But we don't have the margins. We charge smaller rates than subprime lenders like.
Okay, and do you find that there's a lot of demand in that market, and can you price accordingly? And that's going back to this innovation around pricing, which is both return and risk, isn't it? That's what pricing goes off. Do you find that there's enough juice in that space to actually make a decent return?
Exactly. So we see more juice there than in prime. It's an underserved market.
Yeah.
There's less pressure on margin from our distribution channels.
Yep.
And so we can pass through higher returns to investors.
And typically, would you be looking at things, I don't know, there's a US platform, I think, called Borrow First or something, which does consolidation loans at that kind of market, different form of loan structures at the near prime market. Or are you just doing straight loans?
We're doing straight loans for general purpose.
Absolutely.
But consolidation is part of that.
Absolutely. Raj, I just want to pick up with you. Now, you've got a big American operation as well, very successful American operation. You've been in the UK for a while. I think you took over a UK business and rebranded it a while ago. Again, are we talking here just about innovation in terms of the customers you're reaching, really? That's where the innovation is. Probably not a dissimilar message. I mean, I'm guessing you would cover prime and below prime and maybe a bit below, whatever below prime is. Do you want to explain where the innovation is in your model?
Yeah, so I think we take a slightly different approach, I think. And I think sometimes we beat ourselves up defining innovation versus invention.
Yeah,
and
exactly.
None of us had invented the credit market, and it was here long before we were here, and it'll be long here before after we leave. So I think, but in terms of what Avant has done, it's looked at the total market and saw just a phenomenal opportunity in a segment that we didn't think anybody was really owning. So we're sitting just below prime. It's an unsecured product today. Other products coming down the line, but we've had to be pretty innovative right through the whole journey. So right from how we raise funds to support the phenomenal growth that we're seeing. We've had to be innovative in terms of product, but there's only so much you can do with that product.
Absolutely.
However, we have tried to just make the product actually much, much simpler and clearer for the customer.
Let's just talk about that process point, actually. Christoph was talking a bit about, you can do stuff in a few hours, and what is actually quite a complicated transaction in many respects. Again, I imagine that the process is important with you. I mean, it has to be, because you're in a space where, I mean, I don't want to give away, but occasionally I pop along to some like Sainsbury's loans, or I don't know if I should mention them in polite company. But you literally get decision there in minutes.
I'll talk about process, because I think that's where we've really invested, and that's I think that's our strength. So we talk about product. I think we're one of the very few direct lenders that's not charging a fee right now. The product is very simple to understand, and it's very transparent, right? And same-day funding is something that we've innovated in terms of process. John spoke a little bit in his credit talk this morning, today, in terms of how quickly we decision those customers, how we decision those customers, so how we use data, how we use technology. But same-day funding is something we found that customers really want. They want the money, they want it today. We don't use a huge amount of data in terms of how much the customer has to input, but we do use a huge amount of data at the back end. And I think in terms of...
Give me an example of that. What's the kind of... Because obviously in the straightforward unsecured loans market, it's relatively... Most people think it's a relatively straightforward. You just go onto Experian, Equifax, you do your ratings, you press a button, bang. Do you do more? You must do more than that.
Yeah, no, we do
Loads
a phenomenal
more,
amount. I mean, the credit bureaus add very small amount of power to our models. So there's a huge amount. I mean, you talk about all the buzzwords, right? But it's just the way we've tackled how we manage that data, how we kind of trawl through that.
Give me an example. What would be one thing that you would unusually look at without giving away too many trade secrets?
I think, I was trying to draw this out of our tech guys, actually, because they use a lot of these buzzwords and try and confuse us. So one of the interesting things is I kind of challenged one of our really smart guys who works in that area in data science and data engineering. And I said, well, can we talk in a language that resonates so that we can put this into plain English? And he basically said, Raj, imagine you're a monk and you're immortal and you've been living for 1,000 years, right? What we do is, effectively, you will have seen Joe Bloggs 5 years ago, and now you're seeing somebody else with a very similar behavior that this person's had in the past. And what you're trying to do is understand how that customer behaved in those 5 years to that point and try and see if you can predict how this customer is now going to behave by using a similar pattern. So it's just kind of how we think about data. But I think, we've had to be innovative past that point too. So once we've originated loans, we've had to be innovative in terms of what do we do with those loans, right? And there's been a lot of talk about on-balance, off-balance sheet. And I think what we've tried to do, again, is slightly different in that we think we should share some of that risk and exposure on the balance sheet. So we've been pretty innovative in terms of institutional marketplace, on balance, off balance. So that's kind of, we've kind of had to do that all the way through the value chain. And if you think about where we're operating and the yields that we have to generate in terms of the cost of capital that we have to generate, you have to be innovative to lend £2 billion in 3 years, right? So,
and what is just as a matter of interest, looking at both sides of the equation, what's the average cost to the borrower and the average return if you're an institutional balance sheet lender?
So, I mean, in terms of our pricing kind of starts at 9.95%. We kind of, our representative APRs in the kind of 40s. But actually, one of our missions is to continue to lower the costs and barriers of credit to consumers. So our actually ambition is to keep lowering those costs. And in fact, the US, we've been very good at that.
And institutions, what they should expect in terms of return profile? What's the range of stuff?
I think that varies. There's different people have different risk appetites. I think the interesting for us is just the amount of credibility that we've managed to very quickly get in the marketplace with some of the institutional investors that we're talking to right now. So whether it's banks or whether it's private investors or the private equity houses. So,
Stuart, just going to come to you. Now, Assetz, you've been innovating busily from your core business for many years in terms of the property market, so you know all about product innovation. Talk us through how you guys are big, again, because you're lending to businesses, you're lending to SMEs, but you think out the box. Tell me a bit about how you're innovating.
Assetz Capital is a secured business lender, and our loans are quite big. So we're talking 100K to 3.5 million historically. Currently trying to keep it down below the $500,000 mark or so. So that type of secured lending needs people in the credit process. So we're using some technology, but it's heavily people orientated. So our technology focus has been on the retail side. And if you've looked at the site, you'll see that we have investment accounts, which are basically auto-bid on steroids. And it allows people to select sectors and... but
it's not auto-bid on steroids on a mobile phone, though, is it?
Not quite.
No, we'll come to that in a minute.
I've invested on my phone, but it's quite small.
Yeah, exactly.
So our investment accounts are there to give people an ability to select a type of sector, so renewable energy or business lending or... our recent innovation was our quick access account, which provides substantial liquidity. We even have a little counter on the quick access account to show how fast people can withdraw cash, which is currently 0.08 seconds, I think it said this morning.
Quite short.
Quite short. So it's producing products which are retail friendly, and that takes a lot of tech. But the lending side is much simpler, chunkier, and more people orientated at the moment.
And on your products, because your products have got quite a lot of press coverage in terms of what you do with the green products and the investment account, have you found that very receptive? Do you find that, because you're using an old trick, which anybody in the personal finance space has been doing for years, taking an old product, rebadging it, and giving it things like access or giving it a sector theme, is it really working?
It is, yes, yeah. And the interesting thing is we've taken regulation in the UK, Section 36H regulated agreements, and we've put it in a box. Yeah. So it's completely under P2P branding, but it looks like something different. Okay. But it actually is peer-to-peer lending, 36H agreements. Everybody has parts of loans. Yeah. We've just made it act simply and with transparency. And so we've stripped out layers of cost that traditionally might sit inside a fund management business.
Yes, absolutely.
Which is interesting. But we're using the new regulatory regime to do it in a simpler way.
I was going to ask about that because, you know, the regulators haven't really come out and say it, but you can spot a subtext, which is they're growing more and more worried about people using the language of savings. Well, yes, and actually it's investment. We're all adults in this room. We all know.
We're really, really clear that this is investment, and our quick access account is not a savings product. Yeah. It's got investment risk, but it's also got a provision fund. Yeah. It's got a 3.75% rate. It is highly liquid, typically approximately 80% liquid at any time. Okay. Which means we could liquidate the entire account to 80% in cash in 1 second.
And presumably that means the returns are down.
It is, yeah. It's quid pro quo. It depends what people are after. And if you're a cash saver looking for a slightly better than bank return, fine. It's still an investment product, but it's a good 1-2% coupon higher than a bank.
And again, on the sector-based lending idea, that's slightly strong. Some of the crowdfunders have been doing more sector-based stuff, haven't they? I mean, do you find there's an appetite out there for investors to say that I want to lend to a particular sector like green? The green sector?
Yeah, we started, like most platforms started, with a manual lending account. So people read credit reports and decide which lending to take part in. And people still do that in our manual lending account, but it's take your own choice, do your own risk analysis, and don't ask for a provision fund, and get exposed to the full lender rate. Yeah. Fine. And that's all well and good, but we're definitely seeing the mass market wanting to be away from that. I mean, let's look at it. The success of the investment trusts that's beginning to hit retail space is there, and I think we're going to see a lot more of that. In the end, people are busy. So the people that can take the time, have the experience to look at individual loans are more limited. They've got good cash available often, but how much time have they really got to do that? And how many people, percentage-wise, are in that box versus the retail market, just wanting a place to put their cash?
Can I ask just a question actually to you and David, actually, because in a sense we've got a bit of a divide here between those who do a more believe, I suppose, I mean, you all believe in people. I wouldn't say you're against that, but some of you are more technology-driven than others. Just the nature of your credit process, so it's just a reality. I can understand how the guys with technology-based risk analysis and can scale their platforms. You know, you guys, all three of you have shown it in your own distinctive ways. How could you scale what you do? I mean, David, I mean, you know, I've always thought, by the way, that a community-based platform was a brilliant idea, and I'm really happy that you guys are doing well. But how do you scale that? I mean, because that's a real big issue for institutional investors here. They'll be going, very interesting, but I want to put 20 million on something, and you can't scale it, can you?
Well, it is scalable. You know, I meant to say that. It is. I think with we use very traditional methods. Yeah. You know, we're not going to be as tech. Having said that, you know, we're spending a lot of and time and resource to actually put more tech into it to make it more scalable. Because from a you know, community-based lending is still a huge appetite out there, and the ability to actually, you know, there's a definite interest in it, and can it become scalable? Yes, because we're already seeing a growth. Okay. That growth, you know, we've done just over 70 million in 2.5 years. So in comparison to some, it's not huge, but it's you know, it's not to be ignored. And I think that really was in a very a small geographical area. So we're finding now that whilst we are Southwest based, we're already starting to see that interest way beyond our original where our original strengths were. So that's already starting to go. So
where do you think you could get in the next 2.5 years? What would your target be? You did 70 million in the last 2.5 years. What do you think you can do in the next 2.5?
We'll do hundreds and hundreds of millions.
Oh, really?
Yeah, absolutely.
Okay.
Yeah, absolutely.
No, it's It's not bad for Southwest. Well done, Stuart. How could you scale? I mean, effectively, I've been on a stage with you in other events where you effectively said that you're actually a bit like an old-fashioned bank. You employ people from banking backgrounds, and you bring in old-fashioned banking personalised. How can you scale? How can you get hundreds of millions, if not billions? How are you going to do it?
Well, our nationwide network of relationship directors currently handle typically £500,000 loans or less.
Yeah.
As we open that up to £5 million, £10 million lending, same work.
But aren't you going to run
bigger ticket.
But aren't you going to run into the banks? I mean, you know, I bank with a lovely institution called Handelsbanken, who've got branches everywhere and do all the stuff you talk about, and they've built a fantastic franchise. And aren't you going to bump into them?
They're going to stay at the safe end.
Yes.
They're going to stay at the safe end, very safe end. And you know, Handelsbanken is probably one of the best comparables you can name.
Yeah, proper nationwide.
Very good business. Yeah, very good business.
But they are very
not all banks are like that.
No, exactly. Let me pick up on the other contrasting idea around process innovation. The rest of you use a lot more technology in what you do. You're much less personalised. You have to because of the nature of your markets. You just deal with a different scale. How on earth are you going to be able to cope when the next recession comes along? Defaults spike up, and the big data models that everybody thought worked don't. Because isn't that one of the great lessons that we've all learned with big data, analysing stuff? The algorithms don't spot the problem. And it just comes out of nowhere when you get whacked. Who wants to answer that first?
I think there's a misconception that very solid and diligent underwriting cannot be done using a lot of data. Yeah. I think the data allows us to understand the customer, but we do have a very last mile of manual underwriting. At the end of it, the question is just, you know, how long and how much time do you spend on a customer? The reason why we are so fast is because we have innovated, as I said, on the data collection and the scoring of it. But for a final customer, before we approve that customer, we would spend probably about 45 minutes in human touch on that, which is all it needs for us to look at all of the data, all of the recommendations of the system, and eventually follow up on some of these points that we feel require more information. And we've seen that this has helped us tremendously in building a relationship with our customer, which helps us across the cycles, but also helps us to minimize our risk relative to a fully automated set of information. And I think that's where business lending is fundamentally different to consumer lending. Yeah. Our understanding is that consumer lending, you can get relatively good predictability based on consumer credit models that are provided by the reference agencies. That's much more difficult in the small business space, purely because every business has a lot of additional factors that impact the sustainability of the business, and therefore we combine technology to extract and understand and score data with some human input to make a final decision. And
the people who do the last 45 minutes, the last mile, so to speak, of the fintech revolution, I suppose the broadband's last mile, are they ex-banking people?
I think that they're people that we are training. A lot of the staff that we employ is coming straight from university, and we're training them up into the world. So I think they're coming from a split of backgrounds overall.
Right. I just on the consumer side, I'm not putting you in the same boat, but a classic example is I can remember sitting in events a bit like this, and Wonga would turn up, and they'd go, we've got these amazing algorithmically driven models, and I don't doubt they did, which allowed them to lend to not your category, much below proper American subprime. And then the FCA came in and basically told them to dump those rules and stick with the old rules. So my point there is that isn't there a danger that you can be very clever with your understanding, but actually doesn't get you very far?
Yeah, no, I think the world's moved on since those days, and I think we have to remember a lot of this was just market abuse, right? It wasn't necessarily that what they were doing was wrong. It was just exploitation and taking advantage. So I think the world's moved on, but I think the way we think about it, and Avant is very focused on quality. I mean, that's all we focus on every single day. We actually have a lot more headroom to be writing a lot more volume today, but we take a pragmatic approach.
How much more headroom?
Well, lots.
Could you double?
maybe not double, but certainly a lot more.
50,
right?
50%.
Significant.
I'll take that as somewhere between 50 and 100%. Yeah.
Significant. And because we have the yield headroom with it to do that.
Yeah.
But we don't think that's the right thing to do, right? Because we think it's more important to keep lowering our costs, lowering the barriers, and actually reaching a profile of customer where we think that those market conditions will be isolated a lot more because of just the profile of the customer, the work that we're doing. And also we're doing a lot of stress testing. We do a lot of stress testing because we have to with the institutional investors that we have and the bank partners that we have. They're very conscious of that. We're very conscious of that. So reputation is very important. So we're very, very conscious of that. And that's why that we are very smart in what we're doing. But I think we're always conscious that things could turn, and how does that impact our modeling, and we're constantly evolving. I mean, you know, we're evolving those models daily, weekly even, to adapt what we're seeing in the market.
Martin.
I wanted to add a last point to this, which is that in credit quality you have two things that you need to watch for. One is what's visible in the data, and in UK consumer you have very good visibility on that. Good. Probably better than in most markets, including the US. The second is self-selection of people.
Yes.
And that's where process becomes really important. And if you offer the combination of a very fast and transparent process where you get an instant decision and you get funded within hours, and you combine that with risk-based rates, where as a good borrower you get a low rate, then you attract a much better pool of customers than if you put hurdles in the way of that process.
But I don't kind of come back to it, but I mean, if you go, I was astonished. I was looking online just to buy a car recently, and I went to good old Sainsbury's loans because I thought they were really cheap. And I was astonished at the rates, and I know that that's all prime, and then as soon as you go below prime, the rates go up. But isn't the net effect that those guys, the really big guys who are getting that huge wholesale funding, they are going to push you out to the margins where you are going to end up dealing with people who could be riskier, much riskier. And I suppose I accept your point is it's how you mine those near prime and sort of below prime customers to get the right people. But it's not like the mainstream guys aren't pretty damn competitive at the rates there already. And the point on self-selection is, surely don't you end up with people who go, well, look, I know I'm not going to get 3.79 on Sainsbury's, and I can't remember what Zopa's rate, 6.5, something like 5.5, 6.5, 7.5, something like that. I'm just going to head to these guys, and I know that they're probably a bad customer. You're self-selecting the wrong customers.
Yeah, I think, but you're making an assumption there that those customers that are being rejected by those are any less risky than the customers that they accept. The challenge they've got is they can't do what we're doing today, and that's why we're picking up the same customers. So we're still targeting the same customers. They just have slightly different, they're just less than perfect credit scores today. But it might be something they've done in the past. It doesn't mean they're not responsible, and our job is to make sure that they're responsible going forward, and what we're giving them is an affordable product. So I think it's just that, and this is where I think that the opportunity is linking up through partnerships with people like that to say, hey, these are your customers, and you're not serving them, and yet we're happily serving them, and they're behaving in exactly the same way your prime customers are. It's just that you segment them in a separate way. So this is where we think there's a phenomenal opportunity.
So in fact, you can go to the big bank, and it's already happening in the SME market. I mean, you've got a relationship with RBS and a few other people where, if you don't, as an SME, you don't get accepted by RBS, and we've got the government referral program apparently coming at some point this decade. So you've got some, but you're saying it could happen in consumer with the banks.
I think it has to happen, because I think that competitive advantage that the banks have is being eroded every single day. And the other thing is, we're kind of frustrated a little bit in that, because the government, the politicians, the regulators have put an enormous amount of energy into helping small businesses, but I don't think they've focused on the consumer in the same way. No. So, they haven't yet had those engaging conversations with some of the institutional banks to say, hey, you've got to be treating the consumer in the same way that you're helping the small business. And I've observed
one area they're really bad at is treating the entrepreneurs or smaller businessmen who use their consumer loans to fund their businesses.
Absolutely.
Just a practical question. For those of us who understand the FICO terms, because we're a transatlantic business, what within FICO scoring would be a typical kind of customer?
I have no idea. I'm in the UK. Yeah, I think that's. I mean, it's interesting. We're kind of operating in the 620 plus.
Yeah, I was going to say 620. Yeah, I was guessing. 620. Okay, I'm going to have 5 minutes for questions. I'm just going to have one last question for all of you. Mobile. Come on. I mean, the reality of it is, if you look, I go to fintech conferences as well as alternative finance conferences, and you can't shut people up talking about mobile. And yet, as I said, I was struggling to work out anybody doing a mobile platform at all. Why is it not happening? Come on, Stuart, you've got to have an answer.
Well, I mean, people have got apps, haven't they? But we're just not seeing the demand.
Just HTML5 pages done as an app. Yeah.
I mean, we have about 63% of our visitors come out of mobile.
Really?
Yeah.
Come out
to our site.
Really?
Substantial.
Right. So why haven't you done? Why haven't you done?
Well, you can invest through a phone. An iPhone will let you invest, but it could be better. I admit.
Christoph, I'm interested in your view because you deal with a very, very mobile-savvy audience quite often who would transact the original transactions on a mobile platform, if you see what I mean. Either businesses are working on eBay, which is, for instance, Alibaba. They're fantastic mobile platforms. Why has there been no innovation in this space?
I think there will be more innovation coming, which is primarily related to customer engagement and getting sort of the customer more excited about the process and the company. From a mobile point of view, we are mobile optimized, and you can apply and do the process through your mobile. And we do get a lot of traffic.
I was going to ask, what
in a similar way.
It's
similar. It's a very high proportion of people who would come to us through mobile. But I think it's going to be an exciting sort of few years of companies bringing up to support companies like us with great concepts on how to turn the mobile on to sort of create more customer engagement.
Raj, again, in the consumer space, I mean, I imagine that's a real great feel for mobile.
Yeah, it's huge. I mean, majority of our volume's coming through mobile.
Oh, okay.
Yeah.
Very interesting.
And I think that's something, I mean, to be honest, that's probably where we haven't been focused enough.
Yeah.
And certainly that's where we're going to be investing in technology and just consumer behavior. But I think some of the product innovation will come through mobile in the future.
Martin?
Yeah, I agree with that. We see the majority of our traffic through mobile.
Oh, really?
And we are working in the very short term on making credit accessible on mobile in a much easier way than simply transposing your page and having people fill in forms online. But in general, mobile will be the way for consumers to access credit.
You only have to look at China. I mean,
it puts a channel into the point of sale, so people are walking around with their mobiles considering buying things, and that's a very interesting place to look for a consumer lender.
David, I imagine though that would you buck the tide?
Sorry?
Will you turn back tide and say no? I'm insisting on the personal relationship.
I think we were just saying there about there's definitely improvements going to be made. I don't think it would be from our model on the basis our average loan size is 250,000. So it's not going to be the channel that consumers would choose really through that route.
We've got about 3 or 4 minutes of questions. I think there's some people wandering around with microphones, and these lights stop me from seeing. So anybody got a question? Put your hands up now, and I'll see if I can see them. And we'll see if we can get a microphone over to you. Any questions? Or is it the end of the day and you're all desperate to get away? Any questions? Oh, gentleman over there.
We're discussing innovation, so I won't ask you what your next innovation is going to be.
Good point.
But I would like to know from each of you what you think your competitors' next innovation will be.
Stuart. As you're closest to me, I'm going to pick you.
I'm happy enough to talk about ours in a broader sense, in a helicopter sense, because I think the one thing we're missing, we're getting too micro. In a macro sense, we're all innovating, because we're trying to take market share away from the banks. The banks have 3% equity at risk, 4% equity at risk. It's too thin. It blows up in recessions. So really, we're all about trying to make sure we don't go back to where we started and that we have enough capital at risk. And I think platforms should have capital at risk.
How much of your capital is at risk?
Well, that's a good question, all of it. If you think about equity valuation, we get it right or we die. And we're going to be putting capital at risk. UK regulation doesn't suit it properly yet, but there's ways and means of doing it today, and I don't buy this argument that we should not have capital at risk. Our own skin in the game. I don't buy it, sorry. We will, and we'll bring a ton of capital in, and we'll be 10 times better than a bank. Because 3%, 4%, 5% is just wrong. We know it is. We just saw it all blow up a few years ago. So our job in innovating is to bring banking 2 into existence with more skin in the game, more equity, and a safer system that survives the next cycle. That's our innovation.
Christoph, you did a lot with, obviously with Alibaba as a partner, China. China's doing lots of innovation. What's the big innovation on the horizon for you? Anything out there that you've been interested in? They must pop over and see you every once in a while and share a few ideas.
Well, my view on the biggest innovation would be to actually use all of the technology and process that we have and leverage it as much as possible with those people who have the largest customer bases and generally sort of still the largest amount of people who are coming to them for credit, and that is the banks. And I think where it will be difficult to innovate is to compete with banks on their low cost of funding. There are very few non-banks that have that I've seen with access to central banks or that get guarantees on their deposits. So take those two together. They just have a structural competitive advantage that's very, very, very tough for any one of us to compete with. So I think we want to sort of join forces and use each other's competitive advantages and bundle them to provide the best products to small businesses.
Just very quickly, we're out of time. 30 seconds for each of you. David.
Well, I would say, I totally agree with the guys. The one thing about innovation, I would say, is that one thing we mustn't do is to forget about why we started in the first place, for all of us really, and that's to make sure that we're always accessible for the consumer. So don't start getting overcomplicated with everything. Whilst tech is important and all things, but don't overcomplicate matters and then actually go backwards rather than forwards.
Raj?
Yeah, I think in the short term, innovation for us is going to come through strategic partnerships. I think collaboration is the way forward, and I think joint product development, exclusive relationships, exclusive products. That's where we think we're going to be able to grow as quickly as we want to go going forward. And I think lastly, the other thing I'd point out is I think in terms of product innovation and innovation in this sector, I think we're going to see just a huge amount more of it. Generally, and I think it's going to come through a new generation of startups, because I think the generation we're from is we showed probably too much respect to some of the institutions, but I think all bets are off now, and I think some of the rhetoric that people are talking about is we can go for anything long as we have great customer service, customer-centric products, and I just think it's going to be really interesting to watch.
And comply with regulation, exactly. Martin, last thing on you.
I'm not sure if this is a very near-term innovation, but in consumer lending, in many ways, the process of applying for a loan, for a specific loan, and getting declined for that is slightly unnatural.
Yeah.
And especially with mobile and advice-based products, there will be things built that we think about, and probably also our competitors.
Well, I think we've run out of time, so and we're all going to be ushered off the stage. So if any competitors are in the audience, they've just given away all their ideas. Thank you very much. Put your hands together to the panel. Thank you for coming along.